Hello and welcome to episode 9 of the No Bullshit Property Podcast, brought to you by Cert Property, and this is our very first episode of 2023. I'm Paul.
And I'm Howard.
And before we get started with today's episode, just a quick reminder to check out certproperty.co.uk, where you can find the latest UK property news, downloadable industry guides, and much more to help you on your investment journey.
And today we are starting off 2023 with a bang with our very special guest. I'm really excited to talk to him. It's Sky Mapson from Maslow Capital, who are a development finance provider. But before we get into talking with our guest today, Paul, do you want to give us a bit of a roundup of what's been happening in the industry?
Certainly. Well, it was a very, very strong results for Q4 for both sales and lettings, which gives us some real confidence in the market ahead. Zoopla records rental inflation is 12.1% increase versus last year and well ahead of earnings at 6%. Manchester's actually recording the highest increase at plus 15.6% of your average rental. Demand is 46% above average, while total supply is 38% under, so obviously driving the rental inflation forward. Rents in the largest UK cities are registering the fastest growth rates.
Yeah, and that makes sense. Obviously, people returning to cities still post-pandemic, and yeah, those are the main economic centres, so makes sense.
Likewise, in Manchester, the office market take-up reached 1.2 million square foot in 2022, 15% higher than 21 and just 13% below levels pre-pandemic in 2019. A new headline rent of £40 per square foot was also set in Manchester in Q4, and that was the company zero.
Yeah, I mean, that's really encouraging for the office market, which seems to get a bit forgotten about or left behind with the booming residential market. So great to see that strength in the office market there, take-up rates so high, new rental levels being set. The office isn't dead.
Not at all. House prices have also seen the biggest New Year bounce in 3 years, so defying expectations.
Yeah, indeed. You know, you read about the rental growth, but the contrast to that has been a lot of commentators out there saying that they expect house prices to fall over the next year, and this is providing contrary evidence. So again, reasons to be cheerful if you're a property owner or indeed a property investor. I
think what is quite interesting, and we've been talking about this a lot recently, is the shift in owning your own house to renting. And you know, we're seeing the rents rising at the fastest rate for 7 years, and household renting more than doubled since 2001.
Yeah. I mean, I think it's something we can talk about a bit later with Sky, just the dynamics of the residential market, and interesting to get his perception on that as well. So yeah, I mean, it's a clear trend in the UK property market that we're seeing this almost generational shift away from ownership to renting, but being driven by forces outside of a lot of people's control.
So I think let's get started with today's episode.
So, who are you and where do you come from?
I'm Sky Mapson and I'm a partner at Maslow Capital. We are a debt finance business, property development finance business based out of London.
Cool. And obviously we know you through borrowing for residential developments, and you've supported us on a couple of schemes there. So yeah, just giving a bit of a flavour as to what you lend on, what you do, how you can help with the developers or anyone who's interested in investing in property.
Yeah, sure. So Maslow as a business has been around for 13 years. We were originally set up in sort of 2010, 2011 as a small mezz finance business that quickly evolved and pivoted into a senior and stretch senior financing business. We're institutionally backed by multiple different funding lines. We're a team of around 30 now, and we are part owned by a company called Arrow Global. And we provide credit to developers up and down the country, right? So that might be someone in London building a block of 50 flats. It might be someone in Manchester doing 200 houses. We focus on the living sectors. And when I say the living sectors, I mean anything really with a bed in it. So I would say 60 to 70% of what we do is resi, and that could be build to sell, build to rent, co-living. And then I'd say sort of 20 to 30% of what we do is PBSA, so just purpose-built student accommodation. And again, geographically, that could be anywhere in the UK. Like the mandate right now is very much UK focused. And then sort of 10% of what we do could be anything, right? So we are providers of credit, things that can be a bit off of the wall. We've done...
Hence why we've borrowed from you.
No. Yours is fairly straightforward. No, so like we've done some fairly interesting things in terms of like, we've done like a lorry park, we've done some office, you know, and they're sort of select things that we do opportunistically if we like the sponsor and we like the deal. But for the most part, resi development is really our business. And when I say senior and stretch senior, if you think about things in terms of loan to cost, loan to value parameters, if you think of like a lender being a high street bank, typically they might lend 65% of cost, 50% of GDV. We as a business do higher gearing than that, right? So we exist to provide like a slightly smoother, more service-led approach, but at the same time sort of offering a higher geared proposition. So 80% of cost, 70% of GDV type lending. And that's really what we do.
Cool. I know, Paul, you're kind of learning as you go along with this one as well, because
yes,
you're involved in property management, but not so much the funding side of things. So does that all make sense to you?
I think so. Yeah.
So obviously, you know, we're on this podcast giving perspectives quite often on the property market. Interested in your perspective of current market conditions, trends you're seeing or have seen, and just from a lender's perspective on the property market. You know, you read about various different things of where the market's heading. You know, what are your perspectives on it?
Yeah, so if I think about like last year, so January 2022, everyone wakes up, construction costs are going through the roof, right? So I would say the first, if I was to like sort of categorize my year, I'd say the first 6 months were dominated by construction cost increases and problems on site and contractors going bust and the like. And the second half of the year was very much dominated by interest rate increases and Liz Truss and everything that happened there. And it feels like those two things in tandem kind of made last year a really tricky proposition for developers to carry on with projects, to start new projects, to sort of have the confidence to go and buy sites and start from scratch. So I would say last year was a real mess, and that I feel like definitely on the construction side is improving. I feel like people have more confidence now. I think we're through the worst of it, and I think we as a business have managed that position particularly well, and a lot of the developers we've worked with have been intelligent and gone back to planning or have tried to cut costs in terms of construction management route versus traditional contracting routes. And that was definitely a theme I saw last year. In terms of right now, it feels like people are starting to get over the headache of interest rates. I think we lived in an environment where credit was incredibly cheap. You know, it wasn't normal for someone to get a mortgage and pay 1% on a mortgage, right? Like things had to normalize at some point, and that goes again for the development world, right? You know, when people were paying sort of 4 or 5% over nothing, you know, and when I say nothing, over a reference rate of nothing, that creates some kind of mindset, right? But that needs to evolve and change, and I think is evolving and changing.
We've seen that as well, where it's almost been like a complete divide between 2022. The shock happened and everyone was getting to grips with it,
right?
And then there's been the Christmas and New Year period, and everyone's taken that time to reflect and got to grips with it and gone, this is how it is, we've just got to deal with it now. I
would agree with that. So I September, October time, I would have a lot of people coming back to me and just saying, you know, your finance costs don't work for this scheme anymore. And, you know, we're still in conversation with those people now, and they're wrapping their heads around the idea that actually it just is what it is. And it's not Maslow specifically that's finance costs have increased, it's the markets. If you go to a clearing bank, they will charge you a margin over a Bank of England base rate. If you go to an alternative lender like Maslow, they will typically charge it over a rate called SONIA, and that very broadly tracks base rate, right? It's the same kind of thing. So it feels to me like people are coming back from Christmas and they're acclimatizing to it. We'll see how it goes.
Got to, if you want to continue developing and building, you've got to. There is no alternative really.
Yeah.
So, I think it's taken a bit of time for that to not necessarily sink in, but how do you adapt to that? And as you've said, is it tweaking the planning permission that you've got on the scheme you're going to develop? Is it being more intelligent with how you're delivering it? And again, is it construction management or whatever other alternative procurement you can think of? So I think that is the case, that you've just this is the new norm, and higher interest rates are part of it, high construction costs are part of it, but conversely also higher sales prices are part of it, and higher rentals are part of it as well. So that's
I very much agree with that, and I think this year will sort of is going to really sort of wheedle out who's a good developer, who's a bad developer, right? Who was just really riding a market of low finance costs and increasing GDVs in a relatively benign construction environment, and just kind of getting through it, and who's actually creative, who can actually think outside of the box, who can solve the problems, who can go back to planning and actually add value, right? It's very easy to say to go back to planning, but that takes time and effort, and it's a process. If someone's just bought a site with planning, thinks they're going to stick a contractor in there and finish it and sell it for an increase in GDV, then you've got to argue, is that going to be achievable in 2023? But you
wish it was.
I think, but if you think about it, right, I would say, so I've been in property lending now for like 11 years. I would say the first 5 of those were the easiest, right, in terms of the lack of challenges. Like, whilst the whole sort of rhetoric was around austerity and recovering from 2007, 2008, the market was relatively just flat. It was just a fairly straightforward environment. You didn't have big cost shocks. You didn't have big dips in values. You didn't have big movements in interest rates. So it was a really easy environment in which to exist. And I would say since Brexit onwards, 2016 onwards, life has just been, it seems like we've stumbled from one thing to the next, right? You have Brexit, you have COVID, you have construction costs, you have interest rates. And I wonder what 23 has to...
Can't wait.
Let's be positive.
I mean, for me, I've often lamented in some moments about... for us, when we entered development was around 2015, 2016, and it always feels like we've just been like a year behind or a step behind, and every sort of regulation has tightened up every time we've sort of come to that point. And I'm like, God, those guys who were doing it before had it easy. Just press the button and there you go, your building's built and you make your profit. Not belittling it, it's never that easy. But one thing that we often talk about on the podcast is build to rent versus build to sell, because it's very relevant to our business. And with the pressures out there from different directions that we just talked about, are you seeing a shift in terms of borrowers looking at build to rent more than build to sell? What I just said there, tightening regulations and challenges. Build to sell has tightened up in regulatory terms from every angle, whether it's mortgages, whether it's purchase, legals, whatever it is. There's tightening of regulations. So have those had an effect on borrowers that you work with and the directions that they're looking to take with schemes?
I would say we as a business really like the rental space, right? So we really, and that's not something historically we've done a huge amount of. Build to rent is a sector that's always traditionally been forward funded, and as a consequence of that, debt finance hasn't really been a necessity. We've always I would have said 2 years ago, maybe like 20% of what we did was like rental and 80% was for sale. But I would say over the past couple of years, as people have got more interested in build to rent, and as people have got more interested in co-living, we've kind of pushed into that space. I think if you think about a world in which interest rates are going up, people are buying on the back burner because of affordability issues and the whole cost of living crisis. They have to live somewhere. They have to rent. So we really like the rental story. There is some sort of question around the yield that you apply to that rent roll, right? And how that tracks with gilt rates, and what's an appropriate risk premium over a gilt rate for a rental property or rental properties.
It's an exciting conversation.
Let's not dive into that.
I'm taking notes. I'm like, do some Googling.
But I really think that, well, look, one of the things you touched on at the start there, rents are going up, right? So even if there is that sort of ambiguity around cap rates that you apply to rents are increasing, and that's a nice hedge to any uncertainty there. And I really like it's a really interesting space, right? Like co-living as a product is a really interesting product. It's something that's emerged over the past sort of 5-6 years. I indirectly at Maslow have ended up doing a lot of PBSA. It's sort of a natural move for me into something different. I'm not saying that co-living is PBSA, but for a wider demographic, there are a lot of similarities there, right? More compact room sizes, good amenity offerings. Yeah, and I really like that whole sector because from an affordability perspective, it's the easiest to access. But to answer your original question, I would definitely say there has been more of a move towards like rental than just straight up for sale property, and I think that's something that will continue. There is a wall of money that wants to be in the rental space, like institutional capital that wants to own good rental stock in good regional centres. Like you've seen it in Manchester, right? Like just the amount of build to rent buildings that are going up, and I read some sort of stat the other day around like, I think it's like Manchester's rental market is like 99% occupied or something like that. So why wouldn't you want to back that kind of product? It makes complete sense from my perspective.
With the most natural kind of hedge to inflation that you can find, which is that typically lease terms are 12 months or 6 months even, and you can put your rents up to match inflation. As long as the market demand supply is in the right balance. But it's interesting as well on the build to rent. You're talking about the cap rates there. That was almost similar story to what we were saying before about the institutions who are wanting to invest into build to rent. Back end of last year, after the mini budget disaster, they all paused for breath. And there was speculation about where's the yield at now. But since the new year, the conversations we've been having is that whilst there's been quite a significant yield shift potentially in commercial property, maybe 100 basis points, it's far less significant, if at all, in the build to rent space. And a lot of the institutions have kind of taken stock and gone, well, what is the appropriate risk adjusted to gilt, etc. But fundamentally, you can track inflation with this. So therefore, why are we moving out the cap rates, given the occupancy, given the surging rental demand and the story with mortgages and the lowest level of mortgages, etc., etc. So it's interesting to see that has stabilised very much and hasn't seen a massive shift in yields or shortage of demand in the sector as well.
Yeah, I would agree with that. Like, I think if you think about the office market and the narrative around the office market, post-pandemic, people want more flexible working, the demand for office space is lower, naturally lease lengths will be lower, people will only go for best-in-class product, that makes that asset class just generally less attractive, right? If you think about the London office market right now, you see people bidding on properties today at sort of 20% discounts to where they would have bid in the summer. And in that space, you also have the challenge of like the refinancing market, right? So an owner of a big office building in London took out a loan 5 years ago. The loan was at a very, very cheap margin, and they're going to refinance now, and it's all of a sudden become very expensive. So they either have to recap that loan or they have to sell it, and they sell it. And if they sell it now, they sell it at a discount. Whereas you think about the resi space, the narrative is all positive. There's an affordability crisis. People need to live somewhere. Rents keep going up. It's a very, very nice hedge for inflation. So if you want to own something, then you almost certainly want to go more towards the resi space than you do the office market at the current time. And I get it, right? Like I saw it again, like in the PBSA market, right? So we had a number of schemes that came to PC last year. People were lined up to buy them. A lot of the investors that were lined up to buy them just sort of said, hang on, we need to take a pause. But they're all back now. They're all circling again. It all feels a little bit more positive from that side of things. And again, the student space has annual increases in rents. You can inflation linked, etc. People have more demand for student accommodation when there's a recessionary environment because they want to go back to university. Nicer narrative than the commercial sector. So I think those asset classes in the long term will be fine. It was just a bit of a shock, is how I think about it.
Yeah, exactly.
So, what's the most interesting deal you've worked on?
Oh, God. The most interesting deal that I've worked on. Well, I can answer that in a couple of ways. Like, if I think about like asset classes, so like co-living is a super interesting asset class. It's emerging, it's different. Like, if I think just about like a building or a property, we did like a really interesting heritage building in Liverpool. It was like, I think it was like the oldest brick building in Europe or something like that, or maybe the second oldest. So like the scale of this thing was just ridiculous. It was a warehouse. It was being converted to flats, and that was super interesting to see. Like the evolution from empty gargantuan brick building to hundreds and hundreds of flats was super interesting just to watch. Wasn't without its challenges, right? It's like listed heritage building, not easy, but the developer there did a great job, exited nicely. So I think that would probably be one of the most interesting things that I've worked on, just because of the challenge that was there in it, and from what it was to start with.
And to flip it around, the strangest.
Well, the strangest is the lorry park, right? I can't believe it's the lorry park earlier on. Like that as a business is ridiculous. Like it's
How do you even underwrite that?
so well, it's really interesting. It's like you pay for a spot per night, right? And so this, again, I don't know if you want to get too much into this.
Please do. I actually find this the most interesting.
So it's 600 spaces. All you're effectively doing is tarmacking some space, 600 spaces. The chap who owned the property had done it prior, right? So this wasn't his first rodeo, and he knows he can rent a space for a certain price per night. He knows you have a certain level of occupancy. And then you just capitalize that at a yield, and it's really interesting, right? That you have these apps, and lorry drivers come in from Folkestone or something. Dover. They come in from Dover. They can book their space on the app, and as part of that, they get their space. They have access to an on-site cafe. They can have a shower and a meal. There's a little amenities room for them. Yeah, it's super interesting.
I've actually thought about where these lorries go.
They come over, they take a break, then they carry on.
Always on the motorway. Where did they go? Where are these places?
Yeah, super interesting. But that's
we'll be doing one next week.
A new business show.
It's but that's about as interesting as it gets in my space, right? That's as sexy as it gets. But yeah, I would say that's probably the most interesting thing we've done.
So for the hat trick, what's the worst?
The worst is the one that you're into for the longest and causes you the most stress. And over 12 years, there have been a few of them. Fortunately, you can count them on one hand.
And none of them were ours.
None of them were yours, which is even better. Otherwise, I wouldn't be here. But no, it's those, right? The ones that create that sort of genuine stress, And yeah, there's no specific one that stands out, right? We as a business are super conservative. We are, so if I think about things in terms of loan to value and our loan book and where that sits, a lot of our competitors, our space is full of people who do broadly the same thing, right? And you can differentiate yourself in certain ways. One is pricing, one is loan to value, the other is service. And I would say those are the sort of three main things that you do as a lender. A lot of our competitors have just gone to leverage, and they're the people who really, really have problems because there's nowhere to go if things do go wrong. But we as a business have always kind of stuck to our knitting. We've always done the same thing, stuck to the same areas, the same developers. I would say in 80 to 90% of cases, we lend some money to someone once, we lend it to them twice. It's a recurring thing. You build up a level of trust and you protect yourself through that. The people who really have problems are those that either their capital is so expensive that they have to increase leverage, or that they just reputationally haven't got a great reputation, so they have to chase high leverage deals, and they're the people who have real issues. But the point I'm trying to make is that Maslow as a business has been relatively conservative, and we don't have too many things that have caused us that kind of stress.
Very diplomatic.
Yeah, I was just going to say, yeah.
I'm sure there is one that stands out, but you're far too diplomatic to say.
Yeah, no, exactly. That's not for now.
Question about, obviously, you're a lender, we're a borrower, and that interaction. What is there anything you think should change or be done differently, or anything that you look at and go, I wish it was this way, in terms of whether it's that dynamic or just how the market works for providing development finance?
I don't know. I think in terms of how developers and lenders interact, I think that it's a fairly well trodden path. Not much needs to change in that sense. I would say that since COVID happened, it has become a bit more disparate because professionals work from home, and that can create lags in timing and things like that. But I would say that as long as people have a good relationship, they're transparent, there's nothing there that I think needs improving. I think from a lending side, as a lending business, we can definitely evolve, right? There are people who still kind of do it like on the back of a fag packet, and we as a business have tried to be sort of more tech driven, more data driven, and sort of slightly more dispassionate when we make our decisions, like about what is a good loan versus another. And as part of that, you know, we've dug hugely into like land registry data and affordability data and all of those things that help you make decisions. And so I think the lending market generally definitely needs to evolve in that sense. And that really is what makes us probably a bit different to other people in the space, right? A lot of people just say loan to value, loan to cost, pricing, guarantee, it's all good. That's really not the whole story, right? What are you lending on? Can someone afford it in the local market? Do these things actually sell? That kind of thing is super important.
Yeah, I think it's a similar thread from a lot of people that we talk to here on the podcast is property as a sector feels like it lags behind in terms of tech
100%.
take up and integration, 100%. And you know, things are still done a very, very old fashioned way, whether it is the lending, whether it's construction, every stage there's huge betterment.
I think that's absolutely spot on. Property as a sector, it just lags. Like, you know, if I can give you sort of a specific example, when I joined Maslow, our credit applications were, you know, 10 pages long. They were written in Word. It was all sort of just filled in. There was a table with some numbers on. There was some pros, and that was really it, and a map. Now I sit here, the credit applications are like 60 pages long. They take less time to write. A lot of it is just importing from data systems and sources that we have. It's cross-referencing that information, having a human check the outputs. There's no errors because all of the numbers are imported from a spreadsheet. So in that sense, the business has become operationally so much more efficient, and that allows you to scale, right? It's like, you know, in terms of how you appraise an opportunity, if it's one person sitting down trying to work it out all themselves, going through all of the various data sources, trying to draw their own conclusions, generate the information to draw those conclusions, that takes an inordinate amount of time. If you have it all generated for you because you have the appropriate systems and appropriate tech in place, then it makes your decision making so much more efficient.
And we're human as well, and you've got to go through so much data and do all that manually. Law of averages, you're going to miss something sometimes.
You'll miss something. Or you might have a bias, right? You might choose to overlook something, whereas if it's an output from a sort of data source and it's showing you something, then, you know, don't get me wrong, I'm not saying data drives every decision that we make. You know, sometimes you have to think about things differently or find a solution for something, but it does help in my experience anyway.
No, good. It's always an interesting topic of conversation of where that line lies in terms of the balance, and there always needs to be that subjective element to it, particularly in something as complex as lending to a developer to build something like that. In itself is something that's got a lot of moving parts, and there's got to be that subjective element, and it can't be data driven, and it's where that line falls. But it sounds like you've got a good balance of it there. If it's taking you a lot shorter time to write 60 pages than 10 pages,
10 pages, right?
Then definitely you've got a good balance.
If nothing else, that's helpful. But like my job will never be done by like a computer or a robot. But there is definitely some help that tech can provide to you that we've tried to utilise.
Great. Okay, well, thank you very much for joining us today. Been really insightful.
Absolutely, yes.
A lot.
We're going to write up my notes after.
And don't forget to Google about the gilt reference rate. Thanks for joining us, Sky.
Thank you for having me.
Cheers. Thank you.
Thanks for tuning in today to the No Bullshit Property Podcast. If you like today's episode, please let us know on Instagram. Our handle is @cert_property, and let us know what else you'd like to cover. You can also press the subscribe button or follow us, and you'll get all our episodes directly and as soon as they come out. Don't forget to check out certproperty.co.uk, where you can find the latest UK property news, downloadable industry guides, and much more to help you on your investment journey. That's all for now.